Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's October 17th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. What's really moving these markets? More relevant today than ever. It's pretty amazing how the markets change, right? From last week to this week. It was like death a couple of weeks ago. Everything crashing. The media was loving it because their job is to scare the hell out of you, get page views. We all know that. Now I was reading headlines from crazy places, not even crazy places, respectable places. How the historic Dow drop reveals market may be a house of cards. Another one said it's a repeat of the 1987 market crash looming. We have why stocks could fall nearly 40% in the coming months. Again, these are all headlines in the Washington Post. Robust economy has hidden the next crisis. Now you see the market come down. Everything you read is trying to scare the hell out of you. Because what market are we comparing this to? At least the downturn is the credit crisis. That's really the last crash in the market. Not this is a crash, it's a correction. Get more into that in a bit. But that's what people fear. Do I have to take all my money out of the market? Do I have to cash out my 401k? How crazy is it? And I get it. I understand the nervousness. And plus you have the perma bears coming out who've been in hibernation for the past few years. And they're coming out of their caves. Like Ron Paul's out again saying the market's soon going to plunge 50%. She's been saying for the last 5 years. Along with Hussman, who says that a crash is imminent. And this guy's great because he actually says the NASDAQ's going to fall exactly by 57% based on his numbers. Not 50%, but 57%. And the Dow's going to fall by 69%, not 70, not 75, but 69%. And this is the same guy that said the stock market is roughly overvalued by 100% in 2014. So 2014, the S&P 500 is trading at 1,700. It's at around 2,800. Market's down a little bit today. Guess must be 170% overvalued now. I'm not sure. But, you know, guys, when you look at perma bears and even perma bulls, they're very, very dangerous. What does that mean when we say perma bear, perma bulls? That means if no matter what, they're going to be bearish on the markets. They're not going to look at statistics. They're not going to look at anything. Nothing's going to change. They're going to be bearish no matter what. That's just the way they're built inside. It's not personal. It's not anything. But inside, there's negative people. There's positive people. And then there's realists. And I want to try to teach you to be realists because this is about your money when a lot of these crazy people sometimes have agendas. And they just say whatever they want, any number they want, without having research backed by anything. Some of these guys, husband has research backed. Yeah, that's why he's saying the market's going to crash 57%, not 50%. He's got numbers backing this and stuff like that. But to not factor in the earnings growth, the massive stimulus, low interest rates that we've seen over the past 7-8 years and not even be able to change your opinion, it's pretty scary. It really is. And a lot of these guys, yeah, their research is based on statistics that support their thesis. And statistics are a great thing. I mean, you could change certain numbers. You could use different time periods just to prove your point. Right? Like the Case-Shiller. Like they'll say, oh, the market's incredibly overvalued based on a Case-Shiller, which is, you know, it accounts for inflation and things like that. But the Case-Shiller should never be used to value companies. I mean, it's meaningless. And based on this metric, you should have never bought stocks at all since 2010. I mean, they say if it's trading over 20, that you shouldn't buy. It's over 20 since 2010. Look what the market's done. So don't use the Case-Shiller. It's if something's wrong, it's not working. It's not working. Okay, so you could cite that and say, well, based on the Case-Shiller, even it hasn't worked. We got to switch. Can't use traditional P ratios anymore for some reason. We got to refine them and make things better. Someone will talk about the labor participation rate. Another thing that's absolutely meaningless. Which is what? People dropping off the workforce, so the workforce isn't as strong as anybody believes. Look, the labor participation rate has zero correlation with any economic indicator. You go back history or whatever. Sometimes it's high, sometimes it's low. During bull markets, bear markets, there's no correlation. And anyone who wants a job today and is fallen off is because they're lazy. Because you can get a job and you can make good money because people are going to pay you good money. It's a great job market right now. If you want a job, you can go out and get there. You can learn whatever you want. Go to Google, take classes, work for free, whatever you need. You can get a job. This is one of the best economies to get a job in that I've seen in probably 20 years. Okay, people are paying a fortune to hire people, especially if you're talented. Just listen to the conference calls during earnings season. Wage inflation, very hard to get employees, very hard to hire great workers and great talent. This is a great job market, yet late participation rate. You're not talking about that, so the job market's not that strong. You know, unemployment rate's at record lows. Again, they're going to cite things that are in their favor. That's what they do. And even bullish, I'm not even talking about perma bears. I'm not making fun, even perma bulls who are bullish no matter what. Just see the market and say, keep buying no matter what. It doesn't matter. But you have to take a step back and look at things. And people are citing, our debt figures. We're $22 trillion in debt and it's rising. The dollar's going to get crushed. America's going to end. It's horrible. I mean, guys, we could have triple the amount of debt. What matters is, are we paying it off? And we are. We're paying it off, paying on time. And you have to look at both sides of the balance sheet. People talk about the $3.3 trillion coming in as tax revenue on a federal level, or another $1.6 trillion coming in on a state revenue level. We have $15 trillion in mortgage debt. You see your neighbors, everybody's pretty much paying their mortgages, and they won't talk about the nearly $7 billion in home equity that people have in their house that they didn't tap, and they're not tapping because house prices rose. They're not going to tell you those two. Again, you got to look at both sides, because I could use any statistics right now and totally convince you that this is a screaming bear market or a screaming bull market based on the figures I want to use. That's why it's up to you to really take a step back and say, okay, are these just crazy headlines? What do I need to do? Yes, I'm a little nervous. The market's coming down. We came off the credit crisis. Is this another credit crisis? And that's how you have to look at things. And you do that by looking at numbers. And you don't have to get too analytical and too crazy with things like this. But be careful. The people that say, well, student debt's out of control, $1.5 trillion. Most people are paying off the student debt. And credit cards, it's $1 trillion mark. Again, people are paying this off. Auto loans, $1.2 trillion. And I laugh when people say, well, this could be the start of the next credit crisis. There's a lot of subprime car. Guys, you have to understand what caused a credit crisis before making a statement like that. It wasn't caused by subprime loans and mortgages. It was caused by leverage, massive leverage off of these subprime loans, which we packaged into CDOs. I mean, it was incredible. I mean, it was just not CDOs, but synthetic CDOs of synthetic CDOs. I mean, there's a reason why all we needed was a 6% default in subprime loans to basically crash the market. It's like you being on margin, owning $5 million worth of stock and having, just $200 of your own cash invested. You just need a small decline to wipe out your entire investment. That's what happened during a credit crisis. Well, it's just subprime loans. So when you have cars and you don't pay your loan, it's not like houses where you could stay in your home for a year. You could destroy it. The bank's screwed on that loan. They'll just come repossess your car. Sell it to somebody else. Break it down. Parts, whatever. It's not a total loss. Not a total wipeout. They have your address. They have your phone number. They have everything. You have a license plate on it. They know exactly where you are, especially now with all the bells and whistles. I mean, you can't steal a car ever. I mean, GPS systems, everything in your car, you know exactly where it is. They could find you in a heartbeat. So it's a lot different than the housing market, where people were putting nothing down, buying $300, $400, $500 million houses, and then were able to walk away because they had no equity in it. And then they could do whatever they want to the house, destroy the house, and the bank was forced to keep it, and they couldn't sell it at that value. Maybe at a whatever, knock it down or whatever, or sell it, try to sell some of these houses. It's not like that with cars. It's a lot different. Not say the car industry is better or worse. And I know there's a lot of subprime loans and maybe people will default and those rates going a little bit higher. But just look into the story when people talk to you about it. When they're predicting something crazy, look into it. Look into the numbers. It's important. But getting back to last week's crash or the early October crash, and asking yourself, how do I play the markets as individual investors? Because there's so much noise out there. And I can tell you, there's a lot of confusion, a lot of worry. I mean, I'm seeing it just based on emails that I'm getting. I'm seeing it based on analysts on TV, the markets, just the sentiment, how people are very, very nervous right now. And I understand it's 100%. That's why I sent out video updates to my subscribers last week telling them, hey, you know what? Don't worry. This is a correction. Corrections are normal. I mean, they're supposed to be normal, right? But we really haven't seen too many corrections lately, especially since the credit crisis. I mean, nothing meaningful. And I mean, that's 8 years. A few minor, went down really quick and then came back. But they're normal. And why should you not worry? because the sell-off was mostly due to technicals and not fundamentals. I mean, key levels got broken, resulting in what? Automatic selling after we broke through the 50-day moving averages on most of the indices, the 100-day, and then even the 200-day. Then you have all these algos get triggered. Massive selling comes at the same time. That's what you're seeing. Like, how many times can you remember before the credit crisis that you saw massive declines like this in a week or two? Remember, even go back in the 80s and 70s and things like that. When, these are markets that I've studied. When you go back, there's long periods that are dragged out when the market crashes, not crashes, but goes down 10, 15% for 2, 3. It's not like that anymore. It goes down, 7% and 9% on NASDAQ, 7% for the overall market in 2 weeks? It's pretty crazy. And so less than 2 weeks, the S&P 500 lost 7%, and they're both, I believe, off 10% off their highs, or they were off 10% the highs last week. But just the 2 weeks, S&P fell 7%, NASDAQ fell around 8, 9%. And what does that actually mean when you see that? When you see, well, the NASDAQ's down 9%, right? They mentioned on TV, the NASDAQ's down 9%, technology stocks are getting crushed, this and that. It doesn't mean your whole portfolio of technology stocks are down 9%. It means some of those stocks, or maybe, let's broaden this out to your whole portfolio. In the market, the S&P 500 declined 7%. Doesn't mean every stock in your portfolio is down 7%, because I'm sure utilities, consumer staples are probably down 3 to 4%. But then you have technology stocks that were down a lot more, and other stocks in your portfolio, you'll see, and I'm sure you have some of these in your portfolio, everybody does, that fell 20, 30%, much, much more than the market. And that's an opportunity for you, because you have to go back and look at the markets. Like a company like Netflix that got smoked, well, they just reported solid numbers. I wouldn't say it was a blowout quarter. I looked, a little bit deeper into it. They're saying earnings is going to be a little bit light, but from what I see and what I analyze, I said this, I tweeted it last night. You follow me at Frank Curzio if you like. But when you're looking at Netflix numbers, they're paying a lot more for each subscriber now. I mean, they're going to generate $1 billion less in free cash flow. They're changing their method of giving guidance for subscribers, which is always not a red flag. But why, if everything's so great with your company, why are you changing the way you report guidance? It's got to be to your benefit. It's got to be a reason. So I just thought that was interesting. And also, earnings are going to be a little bit light. So you're seeing strong subscriber. Look, I could tell you that, right now our subscriber base increased by 5,000%. We now have, 1 million subscribers to my newsletters. That sounds great, but if I paid like $50 million to acquire those subscribers, that's not great. And that's kind of what you're seeing with Netflix, where they knew they couldn't report a bad quarter this time out because they blew the quarter last time. And 2 bad quarters for a growth company is lights out. So it seemed like a lot got pushed through, and I'm not surprised to see the stock, sell off a little bit. But I'm just giving you an example here for Netflix. Netflix did report very good numbers, and the stock popped. You look at Square, which fell 30% from its highs, 30%. We used the pullback to add to our position, Curzio Research Advisory. It's a position we were still up 70% on, even after the sell-off. We added to the position. Square's up around 12, 13% from its high, from when we added it. And we added to the position last week. Granted, we got lucky with the timing. It was like the absolute low and stuff, but it's falling 30%, not only from the markets, but because, your CFO left, which, look, if a CFO leaves a company that's struggling, it's a red flag. But this was totally different. I mean, she's a great CFO, but she's, they're friends. Dorsey was like, I wish you the best. You're great. She wants to be CEO of another company, which she's going to be, a social media neighborhood company. I mean, but Square is just knocking it out of the park. There's not a CFO out there that wouldn't want that job in a heartbeat. I mean, this company's growing like crazy. It's great. They have amazing product. It's awesome. And yes, it's expensive, but they're growing tremendously. But when you look at technicals and the technicals are broken and the market's in free fall, you have to take a step back. And what do you have to look at? Fundamentals. Like, what do we see with Chipotle, with everything, with the, Ebola scare, Ebola, just, the stock got hammered, got crushed. Then where's the bottom? Well, you find the bottom based on valuation. And the stock fell 50, 60% from its highs, but eventually you're going to come to a level where you're going to be compared to other companies in your industry, and you lose that growth premium, but there's a level to where valuation makes sense. Same for Under Armour, which got crushed. Where was the valuation? What was it? 9, 10, 11, $12, and now, boom, it shot a lot higher. It was 40. But you have to look at fundamentals. And that's how you want to look at when the market breaks down and sells off. So let's go into that really quick. Because based on fundamentals, the market's not expensive. My job is to make you money. If I don't, you don't subscribe to my products. I don't have an agenda here. I'm not a perma bull, a perma bear. I was very, very fortunate, And I was put in a unique position where working for my dad for 20 years, my late dad was a pure value investor. Okay. And if he was still alive, I'd probably be a pure value investor today, managing a value fund. But when he passed, I took over the company. I wanted to learn more. And then I went to work for Kramer, who was a pure growth analyst. So it was almost like working for a perma bull and a perma bear. And just looking at those two styles and mixing, I was very fortunate to have an education in both of those from great analysts, right? My dad was considered one of the best analysts, the Wall Street Journal, Barron's, and one of the best performing analysts. He won the dartboard contest, picking contest in Wall Street Journal, a record 7 times. So he used to compete against other analysts. He ran a record 7 times. And you had Kramer, and Kramer's a great hedge fund manager. You could say what you want about him, but just the amount of stocks that he covers, the knowledge of people he knows is incredible. So I was fortunate to bring those two styles together to learn. Again, it's usually growth or it's value, but you should just any style of investing that's going to make you money. You should be willing to learn it. So I'm always open to bringing people on my podcast and interview them and learning their style and strategies, because I realize that maybe I could take some of their strategy, put it into mine, and as long as it works and we're generating money, that's what happens. So when I tell you that the stock market's not expensive, you probably, there's people listening to this going, "Oh, what are you, crazy? You're out of your mind." Just look at the numbers. We're trading at 16 times forward earnings, growing earnings around 18%. What does that mean? A good way to measure growth is basically if you're growing as fast as what your forward PE is. So if you have 20 times, if you're trading at 20 times and growing your company faster than 20%, that's a good sign, right? We get into PEG ratios and things like that, but that's how you have to look at companies, because you can look at a company that's trading at 10 times earnings. That's expensive because they're not growing earnings at all, or not projected to grow earnings going forward. Or you go to a company that's trading at 25 times earnings and be incredibly cheap because they're growing so fast. So if you're looking at a company that's trading at 25 times forward earnings, which is expensive compared to the market when you first look at it, but they're growing those earnings and project to grow those earnings by 50% annually, at least over the next 2 years. Again, I don't want to talk too fast and throw a lot of numbers at you, but the stock is cheap based on its growth potential. Let's get to my interview with President and CEO of Cambridge, Jay Martin. Jay Martin, thanks so much for joining us on Wall Street Unplugged.
Hey, thanks for having me, Frank.
Well, first-time guest. And one, I want to say I appreciate you doing this interview because I know how much you travel and it's been crazy and you have a big conference coming up. But I gave you a nice introduction, but I want you to talk a little bit about, because you're president and CEO of Cambridge International, one of the leading conference providers. But, what made you get into this industry? Because, I'm sure you attended tons of conferences before taking this job. Did you think you could do it better than anyone else, or that, the industry needed to change? Because what you've done over the past few years with this group is pretty incredible.
So Cambridge House was sort of a family business in 2009, 2010. My dad was running it. And, in 2011, the junior mining market crashed, and we were 100% invested in the junior mining market. And so we crashed with it, and we saw something like 76% of our clientele go bankrupt or become defunct or unable to afford us anyways. And so, it was a critical point for our company, and it was an interesting point for me to enter because we had to ask the question, like, does this business have a future? Or should we, just exit now as best we can? And so, it was a massive opportunity for us to look critically at this business and say, can we diversify out of this pit? Can we reinvent our junior mining conferences to bring value back? And it's really important that we went through that because the biggest threat to the trade show business is the trade show business, right? It's boring, it's archaic, it hasn't evolved in a long, long time. And so, at that point for us, we really worked hard at reinventing our model and reinventing the conference business as best as we could. We diversified heavy. We went into cannabis and tech and drones and health, and then looked really hard at our resource conferences to decide, how can we make these better than anybody else is producing? And even in a bear market, worth attending, absolutely. We accomplished that with the right partnerships, right? I think we've got the best partners in the business, and my business partner, Marin, very well. The guy's a workhorse, relentlessly creative, and he brings everybody else up around him because of his work ethic and brings so many fresh ideas to the table. So I think our content has just skyrocketed, and I'm really proud of it.
Yeah, and Marin's a good friend. He's been on this podcast numerous times. Very close friend of mine. And you know, what's good is for Marin, even from that point of view, is you have someone that spoke at hundreds, if not 1,000 conferences that all resource focused. But what I noticed with the companies or with your conferences is that they're good quality companies. These are good management teams. There's no BS there. And what I love about, as I said earlier, is that a lot of these people are walking through the halls, which when you go to other conferences, as someone like me who've attended numerous ones across all different industries over the past 2 decades, when you have a high profile guy going up there and speaking, he's gone. He's out the back door. No one gets to speak to him. But at these conferences, I mean, you look at Rick Rule, Doug Casey in the mining industry, some of the big names that people love to see, they're on the floor. You get to talk to them. You get to hang out with them. I mean, was that an adjustment that you made? Because I noticed that is huge for people. Because when people go to the conferences and you get to speak to the people that you've been listening to, that you follow, that made you money, that leaves a lasting impression.
Yeah, that's by design. That's in the contract. We have, whether it's on the trade show floor, often we'll have our keynote speakers positioned in booths that are available, whether it's just to have a conversation or sign a book or do whatever they're doing. But the commitment always extends beyond the 30 minutes on stage. And that might just be a reception attendance, or a dinner attendance. But that's why people come, right? They come for that wow factor moment. They want to hear from somebody they respect and greatly admire and look up to, but they also want to shake their hand and have a conversation, right? And you're right, because that's a lot of work, right? Especially if you're a traveling professional speaker, somebody like Rick, who speaks, probably twice a month, if not 5 times a month, all over the world. That's exhausting. It's a lot of work, right? And you want to get off the podium and probably go back to your hotel room and pack up for the next destination. But it's very important that, our attendees are that's what it's all about, right? That's what the experience is all about. And that's why people come, is so they can meet exactly who's on the podium, et cetera.
No, it definitely makes sense. And I want you to talk a little bit about your Cantech conference, which was, I saw the lineup. We spoke about it offline a couple of weeks ago. I mean, talk about like the demand of that conference, the people at the conference, some of the guests, because I'm so glad that it's not just junior miners or any particular industry, because, you can go through an incredible bear market where nobody cares. And you still did a good job filling the seats with the mining conferences. But these conferences where you see whether it's, marijuana or, cannabis, you're seeing all kinds of crazy different industries, even in crypto. It seems like these conferences, tons of people are signing up for them.
Yeah, they're absolutely our fastest grower. And so now we've got the Cantech conference in Toronto, and that's every January. It's in its 6th year now. And we expanded to Vancouver 2 years ago. So we have a conference now in Vancouver called the Extraordinary Future Conference. But they're very similar. They're all innovation and futurist focused. And that allows us to focus on whatever trends are really hitting right now. And, last year, January 2018, all anybody wanted to hear about were blockchain technologies and blockchain opportunities, right? It's been cannabis before that. This year, I'm really watching esports closely. We just had our conference in Vancouver in September. And, there was some of the trends and topics that you've seen over the last couple of years. There was lots of cannabis, lots of blockchain. But the 2 biggest hitting topics from an attendance standpoint, Frank, were psychedelic medicines, like how are we going to treat PTSD, anxiety, substance abuse, treatment-resistant depression with psychedelic plant medicines like psilocybin or psychedelics like MDMA, ibogaine, wild stuff. And when we're assembling these agendas, there's always a risk factor. Like I'm looking at a topic like that that I've been reading a lot about, but I might get just laid out putting that on our stage and have people really questioning my decisions. But it ended up being a massive hit. And the amount of requests for follow-up meetings with those speakers after that event was way bigger than I ever imagined. And the second was esports. We had 8 esports companies on the stage. This is a sector that I am super jacked about, just that the numbers are bananas. If you look at annual viewership, I went to the Dota 2 with the massive esports tournament that travels the world, and it was in Vancouver a couple months back, 20,000 seats sold out. I've been to UFC fights in Vegas. They were not nearly as loud as this video game tournament was in Rogers Arena. And so in January in Cantech, we're going to be having a massive esports feature. It's tough to find opportunities right now. Like it's a massive industry and it's growing very fast. The venture market's catching up with some innovative ideas. So we're watching it really closely. I haven't seen anything that's really blown me away, but we've got maybe, 8, 12 companies in Canada that are at that emerging stage right now who are working on something, whether it's media focused or distribution focused for the esports sector. But it's a hot one.
Yeah, it's incredible too because, and guys, if you're not familiar with esports, just go on Google and put in esports venues, and you're going to see, just major stadiums across the United States completely sold out. I mean, the amount of people that are in these, and you said it is difficult to play, but one of the best things that you can do to play it, not really from a venture standpoint, is the gaming companies. I mean, you're looking at Take-Two, Activision, EA are going all in on esports, and it is definitely benefiting, but it provides a huge growth market for them. But it is going to be interesting, like you said. I'd like to see more venture. How do you take advantage of this? How do you be part of this industry? And I think that's the next level, which you're going to get a firsthand look at, because I'm sure when you have conferences like these, I mean, how do you get attendees? Do they actually contact you? Because I'm sure they're going to see the venue and say, oh, wow, this is esports. Wow, these guys have a good reputation to bring in, thousands of people to these conferences. Would they contact you? You contact them? Because it seems like it leads to a lot of ideas for you guys too, and which is great for people attending your conferences.
Yeah, well, investor outreach happens a few different ways. We do run pretty substantial media campaigns in front of these events, showcasing whoever the keynote speakers or topics will be. And we partner with every significant venture capital media company in North America, probably, to make sure they're at least talking about our event, one topic or the whole thing. And then there's tiers to our investors, right? You have the general admission. Somebody saw an ad, they do invest, they probably invest themselves. They buy a ticket, they attend, and they choose their own adventure. I say they walk into the conference and they can go left, go right, talk to whatever companies they want to talk to, and hear whatever speakers they want to hear from. And then we have second tier, which is our deal room, and this is a bit more of a catered experience, so investors can contact us and request to be signed up for meetings one-on-one with specific companies, whether that's individual deals they want to look at, or they just want to look at, say, they're interested in the VR space and they want to meet all of our VR companies. And so we set that agenda for them, and these meetings then happen on our watch, like within our program, and we can see which companies are meeting with which investors and all this. And then the third tier is a hosted investor program, and so we actually sponsor a couple dozen VVIP investors come to our events, and they come from all over the world. And this is just us, scrolling through our database. If we put 30,000 people through events every year at various conferences throughout North America, there's a percentage of those investors that are super high net worth or just super active in the market. And sometimes just awesome people that I want to hang out with more, and they are very active and invest in a lot of deals. And so we sign them up for what we call our Pangea Club. And the Pangea Club it's a hosted investor program. We fly them out, we take care of their accommodation, and we handpick deals that we know they're going to love based on what they've invested in the last couple of years.
Wow, that's pretty cool. And you also have something that's really cool, which is a video library, right? So a lot of people say that, we're going to talk about the San Francisco conference, which I'm speaking at, which you're running in less than 2 weeks. But for people who can't make this, you have like video libraries and YouTube channels, so you could see a lot of the presentations and stuff like that, right?
Yeah, it's I don't know, but I would guess we have the biggest video library of venture capital content in Canada, and we'd be competitive with almost anybody from a volume standpoint, just because of the frequency of content. Like when we produce an event, we'll leave with 60 to 120 presentations from various experts in the industry, and we do record it all, and it's all available on our YouTube channel. And so to compete from a volume standpoint, you really have to build a conference business to produce that much proprietary keynote speeches, panel discussions, and debates. And I love it. And it's become the biggest. So talking about how do our investors hear about the show, that's become internally our biggest marketing engine. We have more and more people that come to our events and like, oh no, I saw the show. I saw the show on YouTube, right? And that's how they hear about it, and they want to come and see the show live. And I love it. I love hearing that, because for a long time we wondered, if we give all this away for free online, are we going to be chopping our feet off? Like, are we going to be cannibalizing our own event?
Yeah.
And the opposite's happened, right? Like, it's great.
Yeah, and it's cool because you get to see things in real time, where I'm sure that's posted on a later date anyway. So it's amazing you can see some of the favorite people at these conferences, or people that people subscribe to or listen to, some of their favorite analysts. That it's really cool to get that update, and you have that channel, and it's called Cambridge, right? I think, is it for the YouTube channel?
Yeah, if you just exactly search Cambridge House, you'll find all of our stuff there. It's Cambridge House International is the YouTube handle.
Yeah, no, I appreciate giving that in case anyone wants to take a look. Now, let's get to the San Francisco conference because you guys always offer us fantastic deals for our listeners. And Marin's like, whoever comes into Frank could come for free or whatever. So we're not pitching anything here. For me, it's about teaching investors the right places to go, the right people to follow, the right things to look at. And you have your San Francisco conference. I'm speaking at it. Talk a little bit about that because I saw the list of names that are going to be attending and speaking, and it sounds like it's going to be pretty exciting.
Yeah, I'm looking forward to it. And, we've been in San Francisco now for 4 years, and it's one of my favorite conferences just because the international traffic is higher. It's easy to get to San Francisco from anywhere. And you know what, Frank, it's not a great market in the resource sector. And I hear this all the time. People are asking, how you doing? It's not the greatest market in junior mining. But to be honest with you, I love this market. I love it, right? Because the flash is gone, right? The fancy stocks and the big talkers, they're not attending, right? It's quality people who are active in the market, quality CEOs who are pushing their companies forward, quality investors who are actually writing checks. The people who attend a junior mining conference at a time like right now, so, it becomes almost like a little private club because you get access to all the speakers. They have time for you. The investors who are there are legitimate and interesting. And so I love it. We're expecting maybe 2,000 attendees at this conference. We've got about 70 junior mining companies exhibiting, and I think 55 keynote speakers. But in context, that's a small event, and I can't wait. Back at the Hilton again this year.
Yeah, it is pretty cool too, because now I'm going to be interested in attendance too, because you're seeing gold kind of catch a bid right now, right? Where, every reason that people bought gold in the past didn't really exist over the past few years. I don't care if it's higher interest rates, higher debt levels, safe haven, whatever. Gold really did nothing over the past few years. But now it's time to catch a bid where I don't know if people are starting to realize that maybe some of the stocks in the U.S. are overvalued and, we have to look to other sectors. And, this is one of the most cheapest, just out of favor sectors that you could find. But it's nice to see that it's getting a bid, which means you not only are going to get access to a lot of these, great companies, and there are quality companies there, but you're finally getting a market with a little bit of a bid underneath it right now. So I'm interested to see if people are like, wow, we need to attend this event, or they're kind of like, yeah, I'm going to wait. And you know what happens, right? I mean, a lot of these stocks will be up 300%, and then, you'll sell out in 2 minutes, which is usually the standard, right?
Yeah. Yeah, it's amazing how reactive our attendance can be, though. And you're right, it only takes a couple weeks, a bit of a rally, and we'll see a big boost in our numbers for sure.
Well, Jay, listen, thank you so much for coming on. I mean, we covered a lot. I'm looking forward to the conference. I know how crazy it is because some of those people who I know are attending a conference, who I know personally who are friends, are big divas. So I know it's not the easiest thing to deal with. Great people, but I know
I don't know who you're talking about.
I'm sorry, what'd you say?
I said, I don't know who you're talking about.
So I'm sure it's going to be really crazy, but every time I've taken events, it's been fantastic and awesome. I really appreciate you coming on. I'm looking forward to seeing it in about a week and a half.
Yeah, I'm looking forward to catching up in person, Frank, and thanks so much for the support and coming back to San Francisco.
Sounds great, man. I'll talk to you soon.
All right.
Right, guys, great stuff from Jay. And I didn't have him on or interview him to pitch conferences to you, although his conferences are great, fantastic. I speak at him. And even if you listen to this podcast, you get to go to these conferences for free. But more important, Jay has incredible access to I would say the most important thing when it comes to stock investing, and that's people. In other words, Jay can tell us all about sentiment, what's going on at his conferences, based on the people who not only are attending, audience members, stuff like that, but how many people are watching specific presentations. What is that presentation about? Is it on crypto? Is it on marijuana? What's hot right now? What's not? What do investors want to see? What areas do they want? They get tons of emails, have a video library. They get, tons of information for people. And it's a great way to gauge sentiment. And when you're looking at sentiment, you want to kind of look at it as a contrarian indicator. For example, the last conference that I attended, I believe was Sprott, and the attendance was a little light, and it's a mining conference. This one's also a mining conference, which is going to have cryptocurrencies. I'm sure a couple of other things going on there. But when I look at this conference, if there's not a lot of people there, it's kind of like a contrarian indicator. It tells me like maybe gold has bottomed because we're seeing a bid in gold here. Usually, when you see these crypto conferences and you look at, I think it was one in January or February, there were ones in Miami where, there was Lamborghinis, there was girls in bikinis, there was scalping tickets. I've never seen it in my life. There was scalping tickets, which were, I think, $500. They were scalping them for like $1,500, $2,000 to get into this conference. What happened since January in the crypto markets? Okay, it's not a coincidence when you see massive demand, when the massives start getting in, it's usually the time to get out. So that's why I love having Jay on, not just, going to this conference, attending a conference, and I speak at a lot of these conferences. But for me, that's a good indicator by going to these conferences where I did a presentation a year ago at the San Francisco conference and talked about 3 stocks that are going to be from blockchain. And one of those was Square, and we had 2 other ones, but Square performed very well. I forgot what the other 2 were, which I think I think they're okay anyway. But, we did very well with those. I had standing room only. I mean, if I said, hey, I want to talk about the 5 best value stocks, I might have had a couple of my subscribers and 10 people go there. But there was a ton of people. There's people outside trying to listen in, That's a good indicator telling you that maybe we're getting a little bit toppy in cryptocurrencies. And that was in November, I believe. I think last year they had the conference in November. Now they're doing it in October. So things like that are pretty cool. That's why Jay's a great source. And not only that, he provides, discounts to my subscribers so you guys can get it for free. And he does run some of the best conferences. So I'm glad he took time to come on. And any of you guys going to attend the San Francisco conference, I think it's the 28th and the 29th. Just checking my schedule here, which is going to be Sunday and Monday. And it's like a week and a half away. So it's going to be really cool. I'm going to be speaking at the event. You get to talk to me and things like that. Or, those of you who, bought some of my losing positions, you get to yell at me, whatever it is. But you'll get to meet me if you'd like, which would be pretty cool. But I'm glad Jay came on and really, really great stuff. Let me know what you thought of that interview at frank@curzioresearch.com. Now, this is a special segment. And I don't know if we should call it an educational segment or just a special announcement, because, and it's not a product, it's not something I'm trying to build up, but this is something that I'm very, very excited about. And we're going to launch something with Curzio Research that gives you guys a benefit to participate in the growth in our company. Not from our stock picks, not from our newsletters, but the actual growth in our company. And I'm not too sure how many of you are familiar with the newsletter business, but it's one of the most scalable, high-margin businesses in the world, right? Just a matter of once you launch a newsletter, you could, you have 100 subscribers, 1,000 subscribers, but if you get 10,000, 20, 100,000 subscribers, there's not really a lot of cost to expand that reach. Yes, you have to market and things like that, but it's an incredibly scalable business. And the profit margins are very, very high. And although a lot of you are listening to this as subscribers to my products, and you participate in the growth of the stocks I recommend, but this is a way to participate directly in our growth. And we're doing something special because when we look to raise money, or anyone looks to raise money, it's a different ways you could do it. You could do it through private equity markets, and which is pretty cool, but usually it's difficult to raise money that way. You're a private company investing money. You're coming at a low valuation. It's kind of what you see with early stages of Facebook, Uber, Airbnb. Those investors come in like venture capitalists and things like that. But as a company, you have to offer special deals to people and venture capitalists. Sometimes they want a board seat. And more important, investors who come in, you want to make money off the deal. And that liquidity event could take anywhere from 7 to 10 years. A liquidity event is, how do you sell out of your shares? How do you sell out of your stock? How could you take profits? How could you, get your money? And that could come in the form of an IPO, which means we'd have to grow a lot more to be a public traded market, or we'd have to get acquired, right? So other than that, there's other ways, but most of the time you're not going to have liquidity. You're locked up in these stocks. And that's if everything goes well and we're able to build a company. But most small companies don't even get to that point. Most of these companies fail. Your venture capitalist models, hey, invest in 10 companies. At least 5 of them are going to fail. 2 or 3 of them will be okay. One, you want to make, really good. And the other one could be like the unicorn, the $1 billion, which makes up times, 80 times your investment. That's the venture capital model. So most of these don't work. What we're going to do is something different, where we're going to come out with a security token offering an STO. What that means is it's not an ICO, which ICOs, I explained to you guys in the past, ICOs are basically going to give no value to investors. They have no equity ties. A lot of these kids just, who are brilliant and smart, but have very little operational experience, raise a ton of money, and these companies give you zero equity stake, meaning if they get bought out for $20 trillion, you get nothing. It's kind of like when Facebook with Oculus Rift, right? When they took over Oculus Rift and the crowdfunding and everybody invested in that, they didn't get anything. Basically, it's just a utility function. It's like Dave and Buster's, where it allows me the right to purchase coins and play video games. I don't participate in Dave and Buster's growth. The company grew tremendously over the past 5 years. That means nothing. My tokens just could be played at more places that they open. Maybe it's worth more if Dave and Buster's decides to say, hey, you know what, on Wednesdays and Thursdays and Fridays going forward, on Wednesdays and Thursdays to get more people in their shop, that it's 2 for 1. That means you could play, that coin's worth 2 games instead of 1. That's the value of the coin, using the services. It's like a coupon. a lot of people don't know that, and the way these ICOs are set up, where every one of them is going to be deemed a security, means they're going to be regulated by the SEC. And that's where a lot of these things are going to get in trouble, because when you have to we have to register with the SEC, they're going to go back and look at your fundraising and say, wow, you raised as a utility and you raised $20 million because it was a utility. And we're talking about the U.S. markets. If you have a U.S. address and you're the founder of this company, you have to pay taxes on that. That's ordinary, just capital gains. So it's like ordinary income of 37%, I think it is. So if you raise $10 million, almost $4 million goes out the door. Did you tell your investors that? Because for me, if I'm investing in private placement, which a lot of our subscribers do through, our Curzio Venture Opportunities product, they get into private placements. If you're investing $25,000 or $100,000 or whatever it is, say if it's $100,000 just to say, okay, if you're investing $100,000 in a deal, I mean, you probably wouldn't invest in it if you knew that $40,000 was going to the IRS, right? So they never disclose that. You're looking at not just regulatory structure, but a lot of these guys have been spending money, going crazy, and that's not allowed when you're registered on the SEC. I mean, these guys got Lamborghinis and cars, and their sites aren't even up yet. And a lot of these companies that raise money, their sites aren't, they're not going to generate profits. They're not generating revenue. Even if they do, they're not going to share it with you because you're a token holder. Maybe they find ways where you could, if you get more people to the site, they'll give you a percentage of that revenue. But again, it's really nonsense. You're investing in almost nonsense with most of these. So there's over 2,000 of these that trade on crypto exchanges. You go to coinmarket.com. A lot of this industry is going to disappear when it comes to ICOs. But the good news is the top 25 are pretty solid companies, and they represent 92% of the entire industry. That opened the door. All the mistakes that were made with ICOs opened the door for STOs, which is securitized tokens. And that gives people, even smaller companies, access to sell a portion of their business through tokens. And it's tokenized, so it's securitized. And when you look at all the assets, like hotels or anything, now the individual investor has an opportunity to invest in the growth in some of these. They're going to have an equity stake. These things are going to pay you a dividend. And that's the way to invest. It's just like a stock. Now, why do it this way? Because when we do it this way, and there's a lot of laws and a lot of things coming down the line. There's going to be a lockup period of 12 months for us when we announcements, which kind of probably be next month. But you're going to get an actual equity stake in our company. We're also going to pay you a 3% annual dividend annually for the first 3 years, guaranteed. So now it's not just buying a product or buying a newsletter. You're participating in our growth. Also, what we're going to do, which is something special and unique, is this deal is unique by itself, but we're going to start an STO fund, so Security Token Offering Fund, which is unique by itself, but along with this, everything with this deal is really cool. But while I've been doing this process, I want to make sure this deal is very investor friendly, because what we see in the ICO market, it's not investor friendly. And with STOs, I've been very careful, because this is unique. I don't know anyone else that's really doing this with an existing company that pays a dividend and also gives you a direct equity stake in an underlying company, which is Curzio Research. But as I've been passing this deal out, just to make sure that it's structured right, and a lot of my great contacts and hedge fund managers and deal makers and stuff like that, a lot of them have been coming back to me saying that this idea is fantastic. Where not just our idea for Curzio Research, but the way that we're doing this, because it just makes sense how you could sell off pieces of your business and individual investors get involved, and they were looking to do STOs and wanted to learn more about it. So for us, creating this fund is giving us first access to, I truly believe that this is an industry that's going to be a multi-trillion-dollar industry. There's a reason why you're seeing STO exchanges, right? These are just going to be like regular exchanges going forward. So it's going to be probably by next year, you're going to see a lot of regulation come out in this industry. They're going to be deemed securities, which is great. That's how, we're doing everything right now. A lot of ICOs aren't going to register securities because it's going to be very difficult for them to be regulated under the SEC, because a lot of them haven't been compliant under the SEC right now. But with STOs, when you're seeing this part, you're seeing institutions just waiting on the sidelines until the SEC comes out with their regulation for this industry. And once they do, you're going to see a lot of institutions go in there and create platforms. It's going to be just like E-Trade. It's going to be just like, you don't need to take your Bitcoin off of different sites, store them on treasures or ledgers or cold storage devices, where they're going to be insured. So if anything happens, you're going to have that security there, just like a brokerage fund, where if it gets hacked or anything, they're going to cover it. It's going to be insured up to a certain amount of money. But you're going to see the exchanges come out where they're not going to be shady, they're not going to be difficult, but The STO market is what Coinbase is going to too. I mean, they just took over a bunch of companies that they're getting prepared. They're not just going to make money trading the 4 largest cryptocurrencies, which those 4 are great. A lot of other ones aren't that great, which I just explained, but they're going to have companies like ours that are going to come out instead of going through the whole market, which is very costly. It's difficult because you're not, venture capitalists pretty much own you when you do things like this, but it allows us to go directly to the source to raise money where you don't need middlemen like Goldman Sachs, Morgan Stanley anymore. These guys know that. That's why they're going to get into this industry, because you're going to see a lot of smaller companies like ours, maybe it's generating between $1 million and $20 million, where that's too small to do an IPO on the market. And maybe they don't want to do private placements, but here's an opportunity to raise money through this market. You could trade that token. There'll be a lockup period and things like that. But the STO market is here. The research I've been doing in it is incredible, and it's unbelievable. You're going to see the growth in this market. So the ICO market is definitely going to change to the security token market, which is just now these things are going to be backed by equity. They're going to be backed by assets. They're going to be paying you a dividend, which is more investor friendly. These are the type of deals that you want to invest in, not utility tokens where you're not going to get anything other than you get to use the person's site. And some of these guys barely have their site up and running after a year of getting $20 million, which is worth $10 million because they kept it in Bitcoin when they raised the money, and Bitcoin or Ethereum, they're down 50, 60% on the year. Plus they have to pay taxes on it because it was a utility token. And these guys driving around Lamborghinis and stuff, where's the money going? It's a lot different. This is a new market. You're seeing a lot of great companies come out and start launching these things, and it's going to get very, very busy. You're seeing a lot of great platforms. You can look at Securitize as a great platform. Polymath is another one, guys. If you read up on it and start educating yourself. But we're going to have a whole education, sort of everything about this market, and we're creating a fund that's going to invest strictly in STOs and security token offerings, because we're going to be very early to this market, and we're going to be the test case. So that's why everyone's waiting for us to be the test case. If everything goes well, you're going to see a lot of people, at least in our industry, come into this market, I think. But it's something that's exciting. It's a way for us to grow our business. Like I said earlier, when it comes to the financial news on the market, few people know that it's a high margin, incredibly scalable business. They just invest in newsletters, and it'd be nice to participate in the actual growth of the company, which I don't think anyone else in our industry, offers that. Which is, and not only that, you're going to get equity stake in the fund. How many hedge funds do you have an equity stake in? Almost none, right? So you can invest in some of these things. If you have $1 million, $5 million, it's different. So with us, we're coming out of this offering next month. It's a way for us to better compete because we feel like we're disrupting the industry right now, which has turned into pretty much a game where, everyone's Warren Buffett these days. Everyone has 20,000% returns. Everyone's going to make you a fortune by tomorrow. And what we realize, and for someone like me, it's been this industry for 2 decades. It's really becoming a crappy industry. And even from a credit card processing stance, even from, you're looking at chargebacks are through the roof because, there's just hype promotions, crazy stuff being said that when people realize it, they're just calling the credit companies instead of the rest of the company. And, they're resulting in chargebacks. You have Google and Facebook kicking off a lot of our competitors because the marketing has been too crazy. We're not. We have access to hundreds of millions of people. We have, we're in good standing, and people want returns, and they want to see their analysts out there just, doing the work for them, going to conferences, meeting them, having live videos and stuff, and seeing these guys doing the work behind the scenes and traveling all over the world to find you guys the best ideas. And that model's been working on a very small list of names. And this is a way for us to really build our list as big as our competitors and start generating the money that they're making, basically, which is more than 40 times, 50 times more than what we're making right now. So it's a great way to participate in the growth in the company. I'm going to share more of the details with you. I will tell you this, which is going to disappoint a lot of people, and we're not doing this on purpose. We're doing this because we have to, but the security token offering is only going to be available to accredited investors. We'd want it to go to all investors, but the regulation is just too crazy right now. So we want to do everything the right way. Plus, we want to have a lockup period, the first 12 months for investors. Our lockup period is going to be at least 2 years for founders and guys like me and the insiders of the company. But that gives us a lot of leeway in terms of, regulating, watching the market, and playing the market the right way, because the mom and pop investors are the ones that the SEC is really concerned about. And a lot of these guys who just raise money through very small investors, they just did it the wrong way. And that's what's really going to be cracking down on the industry where, these things are risky. You need to know that they're risky. We are a small company. We are doing well. We're growing. But again, most small companies don't make it, and this isn't being told a lot, and it's hurting a lot of mom and pop investors that invest in these ICOs that got crushed. After 1 year, everyone could invest in it. Again, once you invest in this, you're going to have, be part of the company, equity stake and things like that. But we have to go the accredited investor route. So, unfortunately, but that's the only way we could do it, launching this to the U.S. and things like that. So it's something we're excited about. Hopefully you guys are excited about it. I've been working 15, 16 hours a day on it, just really going crazy. Again, everyone involved, lawyers, accountants, stuff like that. Make sure we're doing everything 100% right, and that it's investor friendly. But I'm really, really excited about it. So, guys, if you're interested at all, it's going to come out to our subscribers first. We're getting a lot of demand already, so it's going to go to outsiders. We're using companies like Securitize to help us with the back end products to know your customer and accredit investors and create the platform and stuff like that. Who are awesome. But if you're interested in learning more, again, it's going to come out next month. If you're a credit investor, you can email me personally at frank@curzioresearch.com. I'm not going to share your email address with anyone, and it doesn't mean that you're obligated to invest in it. But if you're interested in it, we just want to make sure we're offering it to our subscribers at the best price, the best discount possible, because we're allowed to do that in the first week. And I want to give it to everyone on our list, and people have been following us first before we really do this and start, going out to the masses to market this thing. So, again, any questions or comments about that? Something I'm excited about. Again, I mean, to spend a whole educational segment on it, but this is all I've been working on, really digging into the crypto markets, especially security tokens. And I'm truly believe there's going to be a monster market and a place for a lot of investors to make really big money, hopefully starting with our token, which is going to be called Curzio Equity Owners Token, CEO. So again, it's coming out hopefully by next month. Everything's on schedule right now. And any questions, frank@curzioresearch.com. So guys, that's it for me. Let me know what you thought. If you have questions, comments, just email me anytime. I'm here for you, of course. And also make sure you listen to my Frankly Speaking podcast, which I host every single Friday. Again, just send your questions in, get tons of questions, especially now with the market going a little bit crazy. Just, relax a little bit, take a step back. It's going to be a lot of ideas, especially open up during earnings season. And I'll be there for you, and I'll report back to you every single week on this podcast. So, guys, that's it for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.